Hello, I would like to find out more about tax planning in Malta.
And now let's talk about tax benefits in Malta. When creating a new taxation system, Malta was assisted by a global tax consultant, whose expertise allowed creating an EU-compatible, but yet pro-business environment. They needed a unique structure that complies with subject to tax regulations of double tax treaties. And it should allow a 5% effective corporate profit tax if companies are owned by non-residents or by residents without domicile in Malta. It works like this: companies first have to pay a profit tax of 35%, and then the recipient of dividends receives 30% or 6/7 tax refund within 2 weeks. Malta is member of the EU. Therefore the parent subsidiary directive applies. If some conditions are met, dividends from a subsidiary company can be received tax-free in the parent company, even across borders.
Does this mean that the refund remains tax-free at the holding?
If the holding is in Malta, this is the case. If the holding is outside Malta, it depends on the tax legislation of the other country.
What are the benefits of having a holding outside Malta?
First, it might be cheaper. In Malta, every company must have an audited financial statement, and this is not the case in most other countries. So you can save the audit costs. Second, the owners can save tax on the private level. If the holding is in Malta, private owners from most countries have to pay tax in their country of residence when they receive dividends.
Is it interesting for foreigners to move to Malta?
Of course, there are a lot of benefits: sunny weather, sea, friendly people, security, a booming economy, and a lot of entertainment. But let us focus on tax advantages. For individuals, the concept of residence without domicile offers tax advantages, because in current practice, foreigners are deemed to be residents without domicile in Malta. They are automatically not domiciled in Malta, because there are three concepts of domicile: domicile of origin, if someone is born as a Maltese; domicile of dependence, if a foreign woman marries a Maltese; and domicile of choice that requires an active declaration. Residents without domicile are only taxable on income arising in Malta, on income arising outside Malta that is remitted to Malta, and on profits from real estate in Malta. Income created outside Malta that remains outside Malta is not subject to tax, and capital gains arising outside Malta can even be remitted to Malta without paying tax. Therefore, separate bank accounts for income and for capital are recommended, and this allows foreigners to have their money at a foreign bank and earn interest rates officially tax-free. If a resident without domicile owns a Maltese company through a foreign holding, the structure qualifies for a refund. This means total tax on business profits remains at 5% as long as they are not remitted to Malta.
One more question. Does the government offer incentives to move to Malta?
According to the Residence Programme rules for citizens of the EU and Switzerland, and according to the Global Residence Programme for non-EU citizens, foreigners can transfer their residence to Malta and benefit from tax incentives if they buy real estate for at least €275,000, or if they rent real estate for at least €9,600 per year. In addition, a fit and proper test and some fees are required. Then the tax on income earned outside Malta and remitted to Malta is 15%, and there is a minimum tax of €15,000 per year. There is also a program for high-qualified individuals who then pay only 15% on their income earned in Malta. And relocation is easy. Malta is a member of the EU, therefore EU citizens are entitled for a residence permit. Also, within the EU, exit tax is not effective, and a tax residence certificate is issued quickly.
A last time, one more question. Is it possible to move companies to Malta too?
In Malta, there are domiciliation rules. According to Maltese legislation, it is possible to apply the concept of residence without domicile to legal entities. If a foreign company redomiciles to Malta, there are additional tax advantages, because such an entity has limited tax liability in Malta, and income arising outside Malta is not taxable in Malta. Such a structure is favorable for passive income, interest or royalties, which are tax-free if not remitted to Malta, because they are deemed to arise where the payer is located. In addition, this structure creates credibility and opens the door to EU directives and double tax treaties. Thank you for watching this video.